Are you interested in how you can use your home equity in retirement, but also scared of the words reverse mortgage? Well, this video series is made for you. I'm going to walk you through the basics of the reverse mortgage step by step to help you make an informed decision about your financial future. And remember, always check with your family and a licensed financial professional before you make this or any other major financial decision. Now sit back and get ready to learn the truth about reverse. And hey, if this is your first time here, please like the video, subscribe to the channel, and be sure to tap that bell for notifications so that you can keep learning right along with us. Those over age 62 have amassed more than $13 trillion worth of home equity, and it largely sits idle during retirement. My name is Brian McRae, and I'm here to change that mindset because every day I see how profoundly my clients' lives can change when we put a well-designed reverse mortgage in place. Reverse mortgage loans aren't for everyone, but in the right circumstance, they can be an extraordinarily powerful financial tool that will help you thrive in retirement. So if you're interested in more information about reverse mortgages or the home equity conversion mortgage, or you have a parent or a relative or a friend with a reverse and you have technical questions, please feel free to reach out to me. You can contact me via cell phone, text, email. I'll be happy to answer any questions that you might have. Today, we're going to talk about what happens at the end, or what happens when a reverse mortgage, the home equity conversion mortgage, becomes due and payable. And this centers around what we call occupancy. One of the main requirements of the home equity conversion mortgage is it's a primary residence, and the borrowers must occupy the home. So if it's a single borrower, that person must occupy the home. And if it's a married couple, one of the people must occupy the home. And so this is really important because that occupancy is what determines how and when and if the reverse mortgage is due and payable. And you are considered to no longer occupy the home, obviously, if you sell the home. And of course, you can refinance into a traditional mortgage at any time if you desire. If you move into long-term care and are there for more than 6 months, that would constitute a maturity event if you were the last homeowner or the last borrower. So the reverse mortgage, remember, becomes due and payable when the last borrower permanently exits the home. And so in a long-term care situation, this gives the married couple the ability to have one spouse move into care and the other spouse stay in the home until they are ready to move and downsize and take the rest of the equity. And so what happens at the end of that? So when the borrowers no longer occupy the home, the loan balance becomes due and payable. There are two factors that determine the four potential outcomes. And the first one is the question, is there still equity in the home? And so in most cases, there's plenty of equity in the home's value, far outstrips the loan balance. In some cases, however, the loan balance does exceed what the home is worth. Now that outcome is guaranteed by the mortgage insurance, but still it's handled a little bit differently in terms of disposition. And the second factor is, do the borrowers or the heirs or the estate wish to keep the home? And so these two factors drive the four outcomes. And so more often than not, there is going to be equity left in the home. And so if that's the case, and the borrowers or the heirs or the estate would like to keep the home, they can refinance into a traditional mortgage vehicle. They can pay the mortgage off, but they have the ability to retain ownership from that point moving forward. If the heirs or the estate wish to keep the home, and the loan balance exceeds what the home is worth, the non-recourse feature kicks in here, and the estate is only liable for the loan balance itself, and only the home can be used to satisfy that loan. And so if the estate wishes to keep the home, an heir can purchase the home for 95% of its market value. And so not what the loan balance is, but what the current market value of the home is. So this way, the family gets to keep the home and the loan balance is satisfied. Now, what happens if the heirs or the estate does not wish to keep the home? And so in this case, more often than not, there is plenty of equity left. And you have 6 months plus up to 2 90-day extensions to sell that home. So you would sell the home, pay the mortgage balance off, and the estate would keep the rest of the equity. And it functions just like any other lien, any other mortgage lien in that respect, in that you pay the mortgage lien off and the rest of the equity belongs to the estate. In the case where the home's value isn't enough to cover the loan balance, and the estate does not wish to keep the home, they simply turn in the keys and walk away. It's a voluntary foreclosure event. And because of this non-recourse feature, only the home can be used to stand for the note. And so there's no recourse against the borrowers or the heirs or the estate. Everyone walks away happy and the loan is satisfied at that point. And so that sums it up. There are four possible outcomes, and those four possible outcomes are based on two factors. Number one, is there equity left in the home? And number two, do the borrowers or the estate wish to keep the home or sell the home? So uncertainty about these outcomes are one of the things that drives much of the fear and uncertainty about reverse mortgages. As you can see, there are only four specific outcomes, and each of those four outcomes is based on very specific criteria. And so, in essence, all you have to do is satisfy the loan balance, and there are guarantees in place if the home's value is unable to settle that loan balance. In our next video, we're going to take a look at the implications of long-term care and how home equity can be repositioned to help pay for and mitigate that risk. Until next time, keep on learning the truth about reverse.